In this lesson, we cross to the other side of the table of a lease transaction. Same lease, same payments, same amortization schedule, but now we're keeping the lessor's books. You'll recall that the first step in accounting for leases is to determine whether it's indistinguishable from a borrow and purchase transaction. When a lease meets any of the 5 classification criteria from ASC 842, the lessee calls it a finance lease. The lessor uses different terminology, calling it a sales type lease, because as far as the lessor is concerned, this asset has been sold. Every lease has 2 sets of books. When the lessee signs a finance lease and records an asset and related liability, somebody on the other side of the transaction is recording the mirror image of every single entry. Today, we're that somebody. And here's the question that frames everything. If the lessee has effectively bought the asset, what does the lessor have left? Not the asset, it's gone. What the lessor has is a stream of payments coming in, a receivable. So here's the lessor's inception entry, side by side with the lessee's. The lessee debits a right of use asset. The lessor debits a lease receivable, measured at the same present value of the same payments. The lessee credits a lease payable, and the lessor credits the asset itself. Equipment comes off the books because in substance, they've sold it. And that leads to a detail that shows up on every test. After inception, the lessor records no depreciation. Think about why. Depreciation is simply recognizing the cost of buying something, but you can't depreciate an asset you no longer own. The equipment has been de-recognized, replaced on our books by a receivable. Depreciation is the lessee's problem now, in the form of a right-of-use asset amortization. Let's start with a clean case. The asset's carrying value on our books happens to equal its fair value, which equals the present value of the lease payments. Maybe we're a leasing company that just bought this equipment at market price and immediately leased it out. The entry is exactly what the mirror image predicts. Debit lease receivable for the present value, credit equipment for its carrying value. Same number on both lines. No gain, no loss, no profit at inception, because we didn't sell it for more than it was worth to us. This is a sales type lease without selling profit. In the first case, the lessor was just in it for the interest. Now, the more interesting case, suppose we're the manufacturer of the equipment. It cost us $24,000 to build, but its fair value, the present value of the lease payments, is higher. When we lease it under a sales type lease, we've really done 2 things at once, and the accounting shows both. First, a sale. We record sales revenue equal to the present value of the lease payments, essentially the selling price, and cost of goods sold equal to the asset's carrying value. The difference is our gross profit, recognized right at inception, just like any other sale. Second, a financing. Over the lease term, we're going to collect interest on the receivable. So the entry at inception actually has 4 lines: debit lease receivable, debit cost of goods sold, credit sales revenue, and credit equipment. 1 transaction, 2 sources of income: profit on the sale today, interest revenue over time. And how do we measure that interest revenue each period? Here's the satisfying part. We already built the table. The lessor uses the exact same amortization schedule as the lessee. The rate times the outstanding receivable balance gives us interest revenue, the same number that the lessee is recording as interest expense, just wearing the other sign. Each payment we collect splits into 2 parts, interest revenue and a reduction of the receivable. And the receivable walks down to 0 right as the final payment arrives. 1 lease, 1 table, 2 mirror image sets of books. Let's work through it together. We'll take the same lease from last lesson, $10,000 a year, 3 years, payments at the beginning of the year at 10%, and keep the lessor's books. First pass, we're going to go no selling profit with the equipment carried at the full present value. Then we'll take a second pass where we're the manufacturer and the equipment cost us $24,000. So we'll record the sale, the profit, and then the interest as the payments come in. Notice how we're going to start this exercise with the same exact calculation of the present value of the minimum lease payments and the same exact amortization table. So this amortization table starts with the value 27,355, but we're working for the lessor now, and we're doing their accounting entries. So at inception, we're going to record the lease receivable. They don't have a lease liability, they have a lease receivable. It's the same amount though, the 27,355 that we calculated for the lessee's liability. And they're going to take the equipment off of their books. Notice we are doing this without selling profit. So we're ignoring the additional information that they gave us here for the cost of the asset, ignoring that in this entry. Then they also at inception get that very first payment of $10,000. They receive it in cash, and that reduces the entire liability dollar for dollar. Receivable reduces the receivable dollar for dollar by $10,000. Then we're going to do the alternative scenario where we do have some selling profit. So we are going to include that $24,000. Now, the entry is the same at the beginning at inception. We still need to record a lease receivable, and we're going to record that lease receivable the same amount as before, the $27,355. But when we go to credit equipment, we have to credit the equipment with what its book value is. What is it on our books at? And that's $24,000. So now our journal entry does not balance, and that's because we're missing a piece. We need to record cost of goods sold. So I'm going to debit cost of goods sold. And we're going to debit cost of goods sold for the amount of the equipment. That's the cost of the goods that we are selling, $24,000. Our entry still does not balance. Now we need to record revenue. So we are going to record sales revenue in the amount of the lease receivable. That's the selling price. So normally a lessor skips this part because they are only in the lease transaction to begin with for the interest. This scenario here, they're not in it for profiting off of the sale of the equipment. They're in it for the lease interest. But in this scenario, they actually are going to earn a profit on the sale of the equipment in addition to the interest that they'll collect with payments. Their year-end entries, regardless of the scenario, is going to be the interest receivable of $1,736 and interest revenue in the same amount. And that's the lessor's side with or without selling profit. To wrap up, when a lease meets any of the classification criterion, the lessor records a sales type lease. The asset comes off the books because it's considered sold, and no depreciation is recorded after that, because you can't depreciate what you don't own. The lessor also recognizes the present value of the future payments as a lease receivable, and then interest revenue over the term using the same amortization table as the lessee. If the present value of the lease payments ends up being more than the carrying value, that is, the lessor is going to collect more money over the life of the lease than the asset's book value, they record sales revenue and cost of goods sold at inception, profit included. In our next lesson, we'll look at the operating lease, where the rental really is a rental.